Imagine running a business where where you lose tens of thousands of paying customers. Like, your top-line revenue visibly shrinks,
Right.
but somehow your operational profits actually stay perfectly intact.
Yeah, it sounds mathematically impossible.
It really does. I mean, welcome to the bizarre upside-down world of corporate telehealth in 2026.
It definitely looks like a paradox on paper. When top-line revenue falls, you just kind of expect the profits to tumble right down with it.
Exactly. You make less money, you take home less money.
Right, but corporate finance, especially in a sector going through this massive post-pandemic hangover, it is rarely that straightforward.
And that is exactly what we are getting into today. We've got a fascinating stack of sources for this deep dive.
We do. We're looking at Teladoc Health's first quarter 2026 investor presentation script, their raw financial filings, and the actual earnings call notes.
Right. And our mission today is to perform a thorough financial health check on this digital healthcare giant.
Yeah, we are going to look way past the raw numbers to understand their actual business status.
Because honestly, if you are sitting there holding telehealth stock in your portfolio, or if you're a tech enthusiast, or, just curious about how a major company scrambles to adapt when the ground shifts beneath them.
Which it absolutely has.
Yeah, you really need to hear this.
Oh.
Okay, let's unpack this. We are starting with the broadest macro view. What do the vital signs actually look like for Q1 2026?
Well, the vital signs are flashing some very mixed signals, honestly. Overall revenue for the first quarter came in at $614 million.
Okay, $614 million.
Right, and to put that in context, that is a 2.4% decrease from the $629 million they brought in during the exact same quarter last year, Q1 2025.
So it's a dip. Not a crash, but a dip.
Exactly. On top of that, they reported a net loss per share of 36 cents, though that figure does include some ongoing restructuring costs.
Okay, so we have less revenue coming in the door and a literal net loss on the books. But here's the data point that made me stop and actually reread the slide.
The EBITDA.
Yes, their adjusted EBITDA, which, is essentially how companies measure their core operational profitability before taxes and all those accounting quirks.
Right.
It remained completely flat at $58.2 million.
It's wild.
It was actually a tiny microscopic increase from the $58.1 million they posted the previous year.
Which is where that paradox comes in.
Yeah, let me push back on this because it just feels counterintuitive. How does a company maintain the exact same profit level while making materially less money overall?
Well,
It's like working fewer hours at your job, producing less output, but somehow convincing payroll to hand you the exact same paycheck.
I love that analogy. The mechanism there, honestly, is ruthless stringency.
Stringency, okay.
Yeah, when a company realizes they can no longer grow their way out of a problem, like when that top-line revenue starts to shrink, the only lever they have left to pull to protect their EBITDA is cost control.
So just slashing budgets.
Exactly.
Oh.
This flat profitability metric points directly to really aggressive belt tightening.
Right.
Teladoc is actively restructuring, and that means they are laying off redundancies, optimizing their cloud server costs, and just slashing their marketing bloat.
Wow.
They are wringing more efficiency out of every single dollar that actually does come through the door.
So the business itself is shrinking, but they're just getting way better at managing the smaller pie.
That's a perfect way to put it.
But we can't just, applaud the efficiency and move on. Since overall revenue shrank, we really have to isolate the problem.
We do. We need to look at the specific business segments driving that top-line decline.
Right, because Teladoc essentially operates two major distinct segments, don't they?
They do. There's integrated care, which is your standard medical telehealth, talking to a doctor on your phone. And then there's BetterHelp, their direct-to-consumer mental health therapy platform.
Okay, let's look at integrated care first. Looking at the notes, and revenue there dipped to $395 million in Q1 of 2026.
Right. And for context, they were sitting at $409 million just one quarter prior in Q4.
Oh, wow. Okay. And the EBITDA for that segment followed suit, right? It fell to $56 million, down from $65 million in Q4.
It did. But, a dip, sure. But in the grand scheme of a post-pandemic healthcare market, it's not necessarily a catastrophic failure.
Yeah, that makes sense. It's operating like a mature business with a slight headwind.
Exactly. But then you turn the page to BetterHelp.
Oh, boy.
Yeah. BetterHelp's revenue dropped to $218 million.
Ouch.
And that is down significantly from the $240 million they posted back in Q1 of 2025.
And the profit, the EBITDA,
The EBITDA plummeted to a highly concerning $2 million for the first quarter of 2026.
Wait, 2 million? 2? Down from what?
Down from $18 million in just the previous
Are
quarter.
you kidding me? From 18 to 2?
Yeah, and at the same time, the raw volume of BetterHelp paying users has consistently declined.
Like, how many users are we talking about?
They went from 397,000 paying users in Q1 of 2025 down to 361,000 in Q1 of 2026.
Okay, so what does this all mean? Look, integrated care is like a slow leak in a tire. It's annoying, but manageable.
Right.
But BetterHelp is acting like a heavy anchor, dragging the whole ship down.
It really is.
Here is what I don't understand, though, and what I think anyone looking at this space would question. Mental health awareness is arguably at an all-time high right now.
Absolutely.
Therapy is completely destigmatized. People want these services. So why on earth is a premier mental health app losing tens of thousands of paying users and just watching its margins evaporate?
Well, what's fascinating here is that high cultural demand doesn't equal a sustainable business model if the mechanics of acquiring those customers are fundamentally broken.
Oh, okay. Meaning what exactly?
The sharp drop in BetterHelp's profitability raises massive concerns about margin improvement, and it all comes down to customer acquisition cost, or SAC.
Right, SAC. So how much they spend to get someone to download the app?
Exactly. BetterHelp grew explosively by blanketing social media and podcasts with ads.
Yeah, we've all heard them.
Right. But we're looking at a market now with fierce new competitors driving up those ad prices.
Okay.
And if social media privacy changes make it, say, 30% more expensive to target someone actively looking for therapy, your skyrockets.
Oh, I see. So if it costs you $300 in advertising to get a new user to sign up, but that user only stays for 2 months paying $80 a month, you actually lose money on every single new customer you bring in.
Precisely. The mental health app space has a really high natural churn built into it.
Like people just don't stay on it forever.
Right. Sometimes patients feel better and leave, or sometimes they don't click with the therapist and they cancel. You are constantly on a treadmill having to buy new users to replace the ones leaving.
Wow.
And when that treadmill gets too expensive to run, well, your EBITDA crashes from 18 million to 2 million almost overnight.
Okay, so BetterHelp is clearly losing ground domestically. That begs the question, if the domestic consumer market is becoming incredibly expensive and completely saturated, where is Teladoc actually finding any wins? Which I guess brings us to the geographic breakdown in these sources.
The geography tells a very, very clear story of where the ceiling is right now.
Okay.
When we break down the Q1 2026 revenue, the U.S. market revenue decreased by 6.3%.
Wow.
Yeah, it fell from $525 million in Q1 of 2025 down to $492 million in Q1 of 2026.
Let me stop you there. Because a 6.3% drop in your primary market is a heavy blow.
It's massive.
The U.S. market isn't just slowing down for them, it's actively contracting.
Right.
It's kind of like the smartphone market. Like, we're well past the era where you can easily find someone who has never owned a smartphone.
Oh, totally.
Everyone who wants a telehealth subscription through their employer probably already has one. You aren't finding new, untapped demographics in North America anymore.
Exactly. You're just fighting for market share. But look at what happens when you cross the border.
Okay.
The international market revenue saw a massive 17.3% growth.
17.3%.
Yes. It jumped from $104 million in Q1 of 2025 to $122 million in Q1 of 2026.
That is a very stark contrast. So the international market is essentially acting as a greenfield for them.
Yeah.
They're finding the growth overseas that simply no longer exists in the U.S.
Right. And if we connect this to the bigger picture, this robust international growth is not just a footnote. It is expected to be the central key driver for future company expansion.
You have to rely on it.
They do. If the domestic market is saturated with existing users, they have to offset that stagnation by aggressively capturing market share globally.
Because the infrastructure overseas is probably a few years behind the U.S. adoption curve, right?
Exactly. The demand is fresh there.
Okay, but let's stick with that smartphone analogy for a second.
Okay.
If you are Apple and you can't find new customers in the U.S., you don't just give up on America.
No, of course not.
You survive by convincing your existing customers to buy the more expensive Pro model upgrade, right? You extract more value from the people already in the ecosystem. Do these patient metrics show Teladoc actually doing that?
That is the pivotal question, and the numbers reveal a real struggle there.
Oh, really?
Yeah. Overall, U.S. integrated care members slightly decreased. They went from 102.5 million down to 101.2 million.
Still a huge number, though.
It is, but the metric to really watch is the average monthly revenue per U.S. member.
Okay. What is that?
It fluctuated. It was $1.27 in Q1 of 2025. It ticked up to $1.34 in Q4 and then fell back down to $1.30 in Q1 of 2026.
Oh.
Meanwhile, the adjusted EBITDA margin for the segment swung wildly. I mean, going from 9.2% up to 13.0% and dropping back to 9.5%.
Let me do the math on that. Having 101 million members sounds fantastic in a press release.
It does.
But if you are only extracting $1.30 per month from them on average,
Yeah,
that tells me the vast majority of those 101 million people are just ghost users.
pretty much.
Like, they have the app on their phone through their company insurance, but they only open it once a year when they get a sinus infection.
Exactly. It's like having a gym membership you use once a year.
Right. You can't build a high-growth company on people who use your service once every 14 months.
You can't.
Yeah.
Which is why the single most important silver lining in this entire earnings report is hidden in their chronic care program.
Okay, chronic care.
Yeah, because while general membership stagnated, chronic care enrollment showed steady, undeniable growth.
What are the numbers on that?
They increased from 1,151,000 enrollees to 1,197,000.
So chronic care is that pro upgrade I was talking about. It's like hiring a personal trainer 3 times a week instead of just having the gym pass.
That is exactly the right way to think about it. I mean, if you have diabetes, hypertension, or require clinical weight management,
You need constant care.
right, you aren't just calling a doctor once a year for antibiotics. You are syncing connected blood pressure cuffs. You are logging in weekly. You are managing daily prescriptions.
That is way more interaction.
It is. And this creates what analysts call sticky revenue. Once a patient is onboarded into a daily health management system, the switching costs are high.
Yeah, you don't want to learn a whole new app.
Exactly. So they simply don't churn out the way a BetterHelp user might.
It fundamentally changes the relationship with the user. They go from being a transactional urgent care provider to being an integrated part of that person's daily survival.
Right. And that steady growth proves there is immense demand for specialized management.
So it's working.
It is. Teladoc's strategic expansion into that specific niche is paying off, and it heavily offsets the flakiness of their general consumer base.
So we have a clear diagnosis of the operational shift here. They need to lean into chronic care and international markets to survive the domestic slowdown and the BetterHelp bleeding.
Basically, yes.
But shifting a massive enterprise like this takes serious capital. Let's look at the balance sheet.
Okay.
Do they actually have the financial runway to execute this pivot?
Well, in terms of sheer liquidity, they have $751 million in cash and cash equivalents sitting on hand.
Okay.
Balanced against that, they have $996 million in convertible senior notes, which is, a form of debt.
Right. I mean, that's a fairly standard leverage for a company this size.
Yeah.
Cash in the bank, some convertible debt on the books, nothing too terrifying.
No, not at all. But then you hit the cash flow statements. On their high-level summary slide, they report an operating cash flow for the first quarter of $10 million.
10 million. I mean, modest, but it's positive cash flow.
Right, but if you flip to the back of the investor presentation and look at the GAAP reconciliation details.
Oh, GAAP, the generally accepted accounting principle stuff?
Yes, the numbers become almost incomprehensible.
Incomprehensible how?
According to that slide, the company generated $9.516 billion in net cash from operating activities.
Wait, billion with a B.
Yeah.
$9.5 billion in a single quarter.
Yes, with a B. But that was offset by $1.66 billion in capital expenditures and an absolutely staggering $34.162 billion in capitalized software development costs.
$34 billion.
Yeah. The slide literally concludes that this resulted in a negative free cash flow of $26.366 billion for Q1.
Okay, here's where it gets really interesting, and I'm going to need you to ELI 5 this for me. Explain it like I'm 5.
I can try.
Because spending $34 billion on software development in 90 days isn't just like releasing a patch for an iOS app.
No, it's not.
That sounds like they're secretly building the Death Star of telehealth.
I mean, on paper, it looks insane.
Right. If you are an investor reading this, how on earth are you supposed to reconcile a $26 billion negative cash flow with the $10 million operating cash flow figure you mentioned a minute ago? Are they just incinerating pallets of cash?
It is an absolute heart attack of a number to see on a slide, I agree, but you have to understand the mechanics of GAAP.
Okay, lay it on me.
This is exactly why financial analysis requires us to separate actual cash leaving a bank account from accounting treatments required by federal regulations.
Okay, so this isn't physical cash walking out the door.
No, no. Let's break down capitalized software development costs.
Hmm.
When a company spends money to build internal software, accounting rules sometimes allow them or require them to treat that expense not as money lost today, but as an asset they are building for the future.
Okay, I follow.
Think about building a physical factory. You don't say you lost $50 million the day you buy the bricks.
Right, you have a factory.
Exactly. You say you exchanged cash for a $50 million asset, and then that asset depreciates over time.
But $34 billion, that's one heck of a factory.
It is. In cases with numbers this extreme in a GAAP reconciliation, it almost always points to a massive historical accounting event.
Oh, like a merger or something.
Exactly. Teladoc has made massive multi-billion-dollar acquisitions in the past, like Livongo.
Oh, right, the chronic care company?
Yes. When companies try to reconcile historical asset valuations, goodwill write-downs, and non-cash amortizations across multiple years of tax treatments onto a single GAAP balance sheet.
It produces these colossal paper numbers.
It does. We also see this in their GAAP net loss adjustment, which went from $93 million in Q1 25 to $63.8 million in Q1 26.
Okay.
That adjustment factors in non-cash items like stock-based compensation given to employees and the paper costs of their restructuring.
So if I'm holding their stock, I shouldn't panic that they just blew $26 billion in cash on a server upgrade.
No, definitely not.
This is literally just the accounting department legally mapping out the complex depreciation and valuation of their historical tech assets.
Exactly. This stark contrast is why analyzing adjusted EBITDA is so crucial for investors.
Because it cuts through the noise.
Yes. Reconciling those massive GAAP figures to EBITDA allows you to strip away the non-cash expenses, the historical write-downs, and the stock-based comp.
Right.
It lets you see the company's actual day-to-day underlying operational earnings power. And on a day-to-day basis, their core business generated a positive $10 million in operating cash flow.
Okay, phew. My heart rate is back to normal.
Yeah.
The Death Star is just an accounting artifact.
Precisely.
Which means we can actually look forward to the future based on real cash operations.
Right.
Based on all these investments and restructuring efforts, what does Teladoc predict for its own immediate future? Like, what is the prognosis for the rest of 2026?
Well, they are projecting a very tight, highly controlled environment. For Q2 2026, they expect revenue to be between $597 million and $626 million.
Basically flat.
Yeah. And if we zoom out to the full fiscal year of 2026, total annual revenue is projected at $2.481 billion to $2.576 billion.
Wow, that really is basically flat. That represents, what, maybe a 2% decrease to a 2% increase year over year?
Yes, essentially zero top-line growth.
Got it.
They are also projecting a full-year net loss per share between $1.05 and 75 cents.
So still losing money on paper.
Right. Furthermore, they expect their U.S. integrated care members to hold flat, hovering between 97 million and 100 million for the entire year.
So literally everything is flat or shrinking.
Oh.
There's a but.
There is. FY26 adjusted EBITDA is projected to hit between 267 million and $306 million.
Wait, really?
Yeah, that would represent a 5% to 9% increase over the previous year.
See, this guidance is remarkably cautious on revenue, but really ambitious on profit.
It is.
It feels like they are steering a massive cruise ship through a narrow, rocky channel in thick fog.
That's a good visual.
Like they're making absolutely no promises about winning a speed race. They just want to assure investors they can safely navigate the rocks and deliver the cargo without sinking the margins.
But this raises an incredibly important question about their internal execution. If your top-line revenue is flat, and your U.S. member numbers are potentially dipping under 100 million.
Which they might.
The only mathematical way to achieve a 5% to 9% increase in EBITDA is through flawless operational efficiency.
No room for error.
None. You can't make mistakes. You have to keep overhead ruthlessly low while simultaneously leaning heavily into those highly profitable, sticky segments.
Right.
Every dollar of chronic care and international revenue has to do the heavy lifting to cover the drag from the shrinking segments.
Which brings us to the ultimate synthesis of this deep dive. Let's look at the whole patient here.
Let's do it.
Teladoc is standing at a major inflection point. The U.S. consumer market is totally saturated. You can't just throw ads at people and expect them to download a telehealth app anymore.
No, those days are over.
And BetterHelp, which used to be a massive growth engine, is now struggling heavily with user churn and crushing customer acquisition costs.
It's a huge weight on them.
But management isn't just watching it burn.
Right.
They are aggressively offsetting these headwinds by tightly controlling their operational costs, expanding into a booming international market, and upgrading their domestic users into highly sticky chronic care programs.
They are being forced to mature, really.
Yeah.
They are trimming away the fat of the pandemic-era boom and focusing entirely on where patient engagement is clinical, consistent, and reliable.
So if you are tracking the digital health space, whether as an investor or just a fascinated observer, the main takeaway from these sources is pretty clear.
Absolutely.
The era of hypergrowth, that pandemic gold rush where every digital health stock rocketed to the moon just by existing, that era is permanently over.
It's done.
The survivors of this new era will be defined by their profitability, their ability to provide highly specialized care, and relentless operational efficiency.
And that new reality leaves us with one final structural question to ponder based on this Q1 data.
What was that?
Well, if international growth and specialized, sticky chronic care are clearly the engines of Teladoc's future,
Which they are.
and BetterHelp's high churn, high ad cost model is acting as an anchor dragging down their precious margins.
Okay, I see where you're going with this.
Will management eventually be forced to make a radical choice?
Wow.
Will Teladoc decide to sell off or spin out its mental health division entirely?
That would be massive.
Because doing so would transform them from a general, everything-to-everyone telehealth provider into a highly specialized, global chronic care powerhouse.
Wow. Now that is a thought to chew on. Sometimes the only way to save the patient is to surgically remove a limb that's slowing them down.
Exactly.
Trimming the business down to its healthiest, most profitable core might honestly be the only way forward. I guess we will have to wait for the next set of earnings reports to see if they decide to take out the scalpel.
I will.
Until then, keep a close eye on those margins.